Test one? Okay, that's great. In the interest of time, let's get going here. I'm Mike Aldridge with Mobius Risk Group. Happy to introduce Ring Energy today, our next speaker. Ring is a growth-oriented independent exploration and production company engaged in oil and natural gas development, production, acquisition, and exploration activities, currently focused in the Permian Basin, which is one of the most prolific hydrocarbon-producing regions in the United States. With headquarters located in the Woodlands, Texas, their primary drilling operations target the oil and liquids-rich producing formations in the Northwest Shelf and Central Basin Platform in West Texas. The management team of Ring has extensive experience in studying, drilling, and producing the San Andres Formation over the past 35 plus years and has drilled numerous vertical and horizontal San Andres wells on Ring's Central Basin Platform and Northwest Shelf assets. Speaking for Ring today is Travis Thomas, their Executive Vice President, Chief Financial Officer, Corporate Secretary, and Treasurer. Prior to joining Ring in October of 2020, Travis served approximately 20 years in a variety of increasingly significant financial executive roles in the oil and gas upstream industry. Travis is not your typical CFO. A fun fact about Travis is that before his entrance into the oil and gas industry, he owned an island bar in Honduras and was briefly a charter boat captain. With that, Travis.
All right. Thank you for the intro, Mike. Thank you, EnerCom, for the awesome conference and allowing me to present. As Mike said, my name is Travis Thomas. I joined Ring in October of 2020. I was promoted to CFO in March of 21. And as for my previous life in the Caribbean, I always have a backup plan if oil goes away and it's not needed again. I actually found out I was presenting this morning after I got dressed. Otherwise, I would have shaved, so I apologize for that. All right, enough about me. Now let's talk about we. Who is Ring Energy? What makes us different? And what is our value proposition? Okay. So with that, let's get going. So there are 5 main aspects that we're going to cover in the next 17 minutes and 40 seconds that will show what Ring as a company has accomplished, what we focus on, and what differentiates us. First, size and scale. It's true, size does matter. The new management team started in 2020, and we have been on the hunt for new deals that would bring responsible growth ever since then. There's lots of kicking of tires, but in August of 2022, we closed a stronghold deal, which almost doubled our size. We used almost 50% equity, so it also improved our balance sheet while remaining accretive on all metrics. We also added 2 awesome new board members. Now, a year later, in August of 2023, we have the founders deal, which is on the line, and which we'll see the benefits of in the next few slides. Next, delivering on record results. 2022 was a record year for EBITDA and cash flow from operations. We saw each sequentially grow quarter over quarter until 2Q23, when we saw a slight pullback, but we'll cover that in a moment and it'll all make sense. We focus on free cash flow and improving our balance sheet. We've been generating free cash flow for almost 4 years. So if you do the math, we were doing it before it was cool and through COVID. As for strengthening our balance sheet, when we started in 2020, we were 4 times levered, and then when the new management team came in, we focused on paying down debt, and now we're at 1.64 times. We'll talk in a little bit about our comparative high free cash flow yield, yet we trade at the low end of EV to 2023 EBITDA and EV to PDP PV10. Ultimately, we'll show you how our value-focused, proven strategy will pull all of these together. All right. Who we are. So, who is Ring? This is a company overview. So Ring is which trades on the New York NYC American with the ticker symbol REI, not to be confused with another company by the same name. We are a unique conventional company that applies modern, unconventional techniques to tight, conventional reservoirs in the Permian. Ring became an operating company through a reverse merger with Ring and a private company in 2012. The assets acquired through the merger formed the foundation for what Ring grew and is currently now at operating levels. In October of 2020, Paul McKinney was named CEO and chairman of the board. And along with him, he brought an entire new management team, and that's how I was fortunate enough to be brought along. As of 2Q23, we had a little over 17,000 barrels. But once we integrate the Founders acquisition, we should be closer to 19,000. Our 2022 SEC reserves were 138 million BOE and a PV10 of 2.7 billion. We have 103 gross acres and 84 net. Looking at the map, our assets are located in the Northwest Shelf and Central Basin platform. In Yoakum, up north, the highest one, we focus on the horizontal San Andres oil play. This is also true for our CBP North assets in Andrews County. CBP South assets in Crane County are vertical multi-stack pay wells. The pending Founders acquisition will fill in the gaps in between in Ector County. Okay, moving forward to our 2Q 2023 highlights. 2023. So 2022 was a transformative year with the Crane County acquisition that helped improve all of our key metrics. And we've been improving sequentially quarter to quarter throughout time. The highlights of the first 2 quarters of 2023 is a testament to the optionality and nimbleness in a changing price environment. To start with, production was 17,000 BOE, which was down about 1,000 from Q1. But let's move on from that, and we'll come back at the very end. As we all know, prices were down in the second quarter, especially gas and product prices, which led to lower EBITDA and lower cash flow from operations. Our budget and guidance was set at oil prices between $70 and $90. So when oil prices pulled back to the low end of that and even below, we made the decision to pull back on CapEx, which deferred production but also increased our free cash flow. During this time, the Founders acquisition was gaining traction. So we focused on more free cash flow to pay down debt, which resulted in a record $204 million of liquidity at the end of the quarter. All right, so that being said, back to production. We deferred some of our projects, both CapEx and LOE, in order to increase our liquidity to have plenty of dry powder for the Founders acquisition. Some of these projects were gas-weighted, and if anybody saw our Q2 financials, we realized a price of negative 71 cents for gas. So it made a lot of sense not to have more gas come online at the time. So it didn't, basically we had lower BOEs, but at the end of the day, record liquidity, and even liquidity ratio and higher adjusted free cash flow. Okay, the Founders acquisition. Speaking of Founders, our PSA has an anticipated closing date of tomorrow. So, spoiler alert, I'm not going to give you any update. The transaction highlights are listed here. The vertical assets in Ector County are similar to the ones we picked up last year. We're paying all cash with proceeds from our RBL, so no stock was used. It actually strengthens the balance sheet with the strong trailing 12 months EBITDA that comes along with the assets, which will be applied to our leverage ratio. The purchase price will be reduced by the free cash flow from the April effective date, and we have a $15 million deferred payment, which is due 4 months after the close. It was a great valuation at 2.2 times the next 12 months cash flow. And what's really cool is it comes with about 50 locations of high rate of return projects that give us additional flexibility in our future CapEx program. Here we've got some pro forma highlights. So quickly on the profile, it's 2,500 BOEs per day as of Q2, 86% of which is oil. And we love the oily nature of these assets. So down to the bottom right, the pro forma company of 4Q23, we anticipate a 5% increase in production with a 1% increase in the oil percent. Proved reserves will be anticipated to be up 9 million BOE, which is a 7% increase. And we're, again, super excited about the additional locations, which should be a 13% increase to the already nice amount of locations we have. The acquisition will also allow us to pull back on CapEx for a 3% decrease. Okay, looking forward to our second half revised outlook. Our second half guidance was revised with the contemplation of the completion of this transaction on time tomorrow. Again, we'll see what happens. No spoiler alert. The midpoint of 18,775 was a 9% increase from 2Q23, which is cool, but more importantly, the 2023 estimated sales is up 50% from 2022. Our CapEx actually gets pulled back a bit to a midpoint of $72 million, and we expect our 3Q23 leverage ratio to remain flat at 1.64 times. And this is kind of a cooler representation of where that leverage ratio has been. So we don't have 2020 on here, but we're at 4 times going back to then, 3.5 times in 2021, and then down to a little over 1.5 at 1.6 for the 2022 and keeping that flat through now. Our ultimate goal is to get less than 1 times levered. That's going to be dependent on pricing and our CapEx program as well. Okay, how are we enhancing the value for our stockholders? So this shows the increases from 2021 to 2022 in our key metrics, which show how our strategy is playing out. Production per share is up 33%. PV10 per share is up 70%. Yes, prices were a factor. Cash flow from ops is up 149%, which is just amazing. And our free cash flow yield up 30%. So year over year, we're feeling pretty good, and we'll see what 2023 has in store for us. A few more metrics. Cash return on capital employed went from 9.3% to almost 12 to over 20 over those 3 years. And all-in operating cost is one of my favorites because we like to be the low-cost operator. This is fully baked with cash G&A and interest. And our cost from this period went up a total of 9.9%. 7.4% of that was just from 20 to 21. It basically shows our low-cost, high-margin wells can perform as we effectively hold our costs down and benefit from the higher margins and higher prices. Okay, capital intensity. This one's pretty cool, and our team spent a lot of time putting it together. I'm not sure if I can do it justice here, but Marino is happy to give everybody a breakdown in the one-on-one later. Essentially, it shows that our maintenance production to replace those reserves would be below sub $20, which is the lowest out of our peer group. The black diamond is the total DNC guidance, which we can look deeper into later. Okay, ESG. This was, of course, a big talking point the last few years. It has remained a focus for us, and we're very proud of everything that has happened with our ESG program. Our CEO, Paul, likes to say we are not a check-the-box company, but when we saw this slide, we pointed out that we are literally a check-the-box company if you look at the right side of the graph. But we do take our program very seriously. We created the task force in 21. They report to the board and senior management. Marino actually started the Target Zero 365 safety program with the Target Zero Day listed on the right, and a target day is 0 reportable injuries, 0 reportable spills, 0 reportable accidents, and 0 unintentional gas releases. We get a report card monthly that shows how we're doing, and the metrics have improved over time, basically as all of our people got on board with the program. And as we integrate new assets, it's nice to see how those numbers and metrics get in line with our historical ones. One thing to note here, as far as driving, management is not tracked with the GPS, so we don't show our speeding incidents for them. Not a problem for me. In 2023, we're putting some capital to work on fugitive emissions. We're actively tracking the progress of the methane tax discussion, and we're trying to get ahead of the curve. Whatever we can do to cut these emissions now and plan for reducing year over year and getting to a good spot is going to give us, put us one leg ahead as we get to the next few years. As for social, we've been very involved in our communities, both in Midland and the Woodlands. Habitat for Humanity, just as a note, it is a little hot to build a house in Midland, but we did it 2 weeks ago. So we also focus on adult literacy in Midland and the YMCA. We were the site sponsor for the Dragon Boat Racing. So if any of our bankers are here, we hope to see you all again next year. Okay, on to the value proposition. So these basically show how Ring trades compared to our peers. The industry is trading low in general for the EV to EBITDA, but Ring is trading even on the lower end of that. So 2 spots down from the median and only 3 up from the very, very bottom. We also trade on the low end of EV to PV10, even though we have competitive metrics on free cash flow yield, CROCI, and capital efficiencies. We're also at the high end of free cash flow yield, which should only improve once the Founders acquisition is closed. Despite these strong returns, significant cash flows, improved balance sheet, and meaningful growth, Ring continues to trade at a discount to its peers. So, in closing, now that you've heard about the Ring story, I want to leave you with just a few thoughts. We're trading at a discount, even though we're delivering competitive returns. Our unique conventional strategy delivers superior results. We will continue to pursue accretive, balance sheet enhancing acquisitions to build scale and inventory. And our ultimate goal is to position Ring to return capital to our shareholders. So with that, I'd like to thank you. Apparently it's one word now, for sitting through this after lunch, and we'll look forward to talking to you guys throughout the rest of the conference.